AgCountry offers a wide range of internal growth. If you have a goal in mind and you put your mind to it, your successes can be endless.
There are so many jobs within this company that you can rotate into.
I like challenges. AgCountry gives me challenges.
Yeah, AgCountry is a great place to work. There's plenty of flexibility. You're never tied to your desk. There's a team here that is always there for you.
Yeah, grab your role and run with it. And always be aware of the opportunities because they're in front of you.
I don't know if mine's working. Is it?
No.
Is it working now? Okay, perfect. We've got the green light. So welcome everybody to Big Iron Day 1. Pretty nice day for today. So I'm Bobby Sondriel. This is Dane Larson. We work at AgCountry, and we each have a little bit different role, and we're going to talk a little bit today about mapping your future, smooth and tax-smart succession and retirement. So I'll let Dane start out by telling us a little bit about himself and what he does at AgCountry.
All right. Well, I've been working with tax planning and preparation with AgCountry for quite a while, since 1989. Can you hear me? Oh, it was pretty loud. Okay. But anyway, so I grew up on a farm about 15 minutes northwest of here. I farmed most of my life on a seasonal basis, but I also had a second career, and that's having the privilege of helping farmers with their tax plans. And a bonus that I get to do with not only the tax planning, I get to work with people like Bobby, who helps with this, with transitions and successions and retirement. And I totally think it's a great honor for me to have this role, and I look forward to the job that I have. I get a front row seat to a lot of farm operations, and it's a lot of fun. I look forward to that. So anyway, thank you for coming.
All right, I also forgot, and I knew I would. If anyone wants a paper copy of the presentation for notes or anything like that, Teresa will hand out for you. Just raise your hand quick and she'll get you one. Like I said, am Bobby Sondriel. Dane is sweet talking that he gets to work with me. I'm not sure if he actually feels like that every day. But I grew up in Galesburg, North Dakota, if anyone knows where that tiny town is. My family farms near Hillsboro. And I work out of our Grand Forks office in the succession and retirement planning area. So like Dane said, we get to really dig into what people's concerns are, what can we help them with, and every day is a little bit different, so that's pretty fun for me. I will also say, Dane won't, he said he farms, but I think I'm really lucky to have Dane here because he also brings the farmer perspective. So not only does he understand taxes, he also can bring his perspective. He's been through a lot of the stages that we're going to talk about, so he can give us some advice as to what to do and what not to do, right?
Well, we'll try. We're not weather forecasters. We don't have a forecast, but we can help you, guide you that way. Yes, yeah, we can.
So the basis of our presentation is basically that everyone is in transition. So I used to not like our job title, succession and retirement planning, because people thought, well, I only have to talk to you when I'm at that stage, when I'm just about ready to either pass it over or retire. Well, that's not the case. So we're going to use kind of a map to go through the different stages that we help people with, whether it's the beginning stages when you're just getting started, that middle stage, we'll call it the growth stage, or when we are ready to either transition the farm or retire from farming. So no two farms are the same. That's why each of my days are different. Same with Dane. He can't just say you should do this because the last client did that. That doesn't work. So it's challenging, but also fun. So each stage, you're just trying to prepare for what's next and be ready for whatever that might bring. So we're using this little map. I told Dane it kind of reminds me of the days, and I am this old, where before you left, you would have to print out the map quest and bring it with you and try to follow it. And then when you didn't, you got yelled at because you didn't tell them where to turn. Well, thankfully, we have GPS now. I still will likely get yelled at for not giving the right instruction, or I couldn't hear it. But anyways, stop number 1 is going to be where we're planting the seeds, that initial stage of farming. So what kind of things do we help people with, help them understand, to try to set themselves up with the best foundation for success in the future?
So when we think about starting farming, you're at that initial stage of the map. You're likely working with your parents in that transition. So, but at that time you're starting to farm and thinking about this process, come in and talk to us, and we can help you with the business side of it. A lot of people start out as sole proprietors, a simple operation, and work their way that way by building acres and enterprises that way. So that's the first part of it. And if you start out really well, and we can allow us to help give you advice, it will pay dividends down the road for the people in the first stage. And we work together with the parents and grandparents. I mean, I've got some farms I'm working with 3 generations right now, and we can structure your business to have a good start.
So on that, if you do decide, or you're jumping into a business with someone, whether that's down the road or right away, and you have an entity, you want to make sure you have a written agreement while you agree about what the terms are to run this entity. So we also might look at tax structure. How is this going to benefit you tax-wise? If there's multiple owners, we just need to have some structure around that.
And one of the things that happened with this big, beautiful bill was the FSA limits have gone up from 125 to 155,000. And another real benefit is that multi-owner entities can each get their limit with that entity. Before, it was just one limit for that. So it makes it simpler in that regard. We don't have to have a bunch of entities to get the limits. So that's a helpful thing.
For example, a general partnership used to be our most common, because you would each partner would get their own limit. And anything that limited your liability, like an S Corp, an LLC, an LLP, anything like that, you would just get one limit for the entity. And now those will look through as well, everything but a C Corp. So that's a change, and that is something that you might want to review at that whenever that stage is.
Yeah, and all along here, when we think about planning and the whole first stage, we have to recognize your family living expense and those type of things do end up on your tax return, or they should. And the planning for that, we can help put you in the right spot with that and manage that your outside expenses. Now we got to think about if you're married, does your spouse have off-farm income? Can that person bring in income that's not from the farm, which will enable the farm to reinvest itself more and grow faster? Because if it's not family living, it can go right to the farm. So that's very helpful. And you get benefits too if your spouse or you have off the farm. So it's not one size fits all. Everyone's different.
Yeah.
Yeah.
Might seem like we're trying to parent as well, but sometimes you need a little extra push to understand you might want to start here, because scaling back is probably not that easy. So do we have off-farm income, or do we need to have off-farm income? And sometimes parents don't want to say that. Hey, maybe your spouse should get a job. So they might come to us and say, hey, maybe you will say that for us. I would love nothing more. But the reason being, we have some cash flow considerations. So we all know the expenses that go into the farm. It's not easy, right? It's not easy to make money. We just heard the market's probably not great news. So is the size of the farm feasible to bring someone in on a full-time basis, or do we need to have some off-farm income either from that future farmer or the spouse? I also think it's really important in those beginning stages to have that conversation between the senior farmer and junior farmer as far as the expectations. I I know you want to give your children a break, and my dad is actually here, so I would love all the breaks you're willing to give me. But you also need to have them realize what the true costs of production is, because you're not doing them any favors if they never figure that out. So having that conversation and clear expectations between the parties as to what's land rent going to be? Do I expect you to purchase it? Machinery and equipment, do you need to cover some of these labor costs, liability insurance, all of those things. And if you want to give them a break after the fact, maybe fine, but they need to understand their break even. And so we really focus on a lot of time of that education there.
Yeah, education is key, and we do some coaching and advising, but we do some cheerleading too, because we are an advocate for our clients. We want them to succeed.
If anyone else is picturing Dane actually cheerleading, so am I.
Yeah. Well, your live event, we got Chase right here.
Yeah, we're dressed the same.
Right?
If you want to do a cheer, go ahead. But first do this slide.
Okay. All right. So, you're in that first stage of farming, so you got to have mentoring. You should have somebody that is a good mentor. We can't be the only mentors that help you. You have to have maybe your dad or grandpa knows something that you don't know. Don't be afraid to ask, because they'll be more than willing to offer the advice. If you have a peer group, have a group of people around you that will offer good opinions and thoughts on where you should be. Is it a Bobby? Is it your crop insurance agent? Is it your advisor? Credit advisor? Is it your tax person? Is it your farm accounting person? Do you know, with good records and accounting, if you made money? Because the 1040 Schedule F does not tell you if you're making money. It just tells you how much your deposits were and how much your expenses were for that year. So that's important to have, is really, really good records. And we have that department that has the ability to keep track of your records and have cash flow projections and earnings, actual earnings. Okay. So.
And it's okay to identify where you don't have strengths. You're good at a lot of things. I'm not great at farming, right? But I'm great at this, right?
Yeah. Oh.
I think. Oh, there's my cheerleader.
Yeah.
But identify those weaknesses and find the people that fill that void for you that can help you. Don't be afraid to ask for help. You can't do it alone. We didn't wake up knowing everything.
And when about 10 years ago, my son and I went to, it's TPAP. It's down in Austin, Texas. It's a Texas Extension thing. It's a week-long deal where a lot of good advisors come in, they coach, and you get to meet maybe 100 other people wanting to do the same thing all from around the world. Those type of things are very valuable to be part of. Yeah.
So think about all those things.
Oh,
and
one other thing. I didn't touch on the grain marketing.
Okay, you go ahead.
I've seen a lot of frustration when people look at their hedge statement and see losses, and they're frustrated with their marketer and that. But we would really encourage you to really get better at marketing and get somebody that knows something about it and help coach that, because that's all profit, that if you can market 10% better than your competition, that's all profit for you. So I would really encourage marketing. So, yeah.
Never stop learning, never stop trying to get better.
Nope.
So in those young stages, again, you don't want to see me, I'm not going to die, but when you do have young families, you need to make sure you have an estate plan in place that names a guardian. So who would care for your children in the event that you are unable to do so? Who would manage their financial affairs if you and your spouse were to pass? So we would maybe select a trustee. When can they have that money? Should they have it when they're 18? You guys, what'd you guys do when you were 18? Should you? Maybe not. Again, my dad's here. I don't think he should have. Also, how do we want the assets distributed? At this stage, we likely don't know. Will we have a future farmer? Will we not? So we just need to figure out how will our assets be distributed. Also, life insurance, not here to sell you life insurance, but really important when we're young because we're usually healthy. We can usually get term policies pretty cheap, and they're really important for income replacement for our spouse if something happened to us, or covering the liabilities. We're buying land, and we need to cover that liability so our spouse isn't forced to sell that in the event that something happened to us if that's not something that aligned with their goals. So that's something to also give your family some stability on the financial side as well. Yeah. So moving on to stop number 2 on the journey. We're going to grow the operation. So this is our growth stage. What kind of things are we thinking about, planning? Might be some repeat, but maybe reviewing some of those things.
So Grandpa's probably out now and totally retired, and now you're making all of the decisions. So when we look at this stage of your life, it's not necessarily a certain age. It's wherever you start being the one making the main decisions. So we always, when we're doing tax planning, we always think about, is there an entity that might be better suited for your operation? We think about those things. We talk about them. We discuss and we discuss it. We don't always go into an entity, but it's important to always have that option available. So are we going to, there's some C corporations that have gone into a different type of corporation where there's some tax benefits to be an S Corp now with the 199A deduction. So that has been a pretty popular thing to do, to do that if you have been a C Corp. But that's a long discussion that you'd have to be in the office with to talk about. So think about that. Okay, so are you a general partner? Maybe we should go to a partnership that's got some limited liability to give you some protection that way. So when you get the protection of that, plus you also get some market valuation discounts that happen when you do a limited partnership. So, and allows you to bring in new owners when you have a limited partnership too, with maybe some discounts and how that works. And when you're, instead of just having a sole proprietor Schedule F and you move into an operating entity, now you're maybe renting your land to that operating entity. There's a lot of things we can do if you give us the tools to help you.
Yeah. So as things change, as rules change, it's always good to review and say, is this still right for me? Not just doing it because we've always done it that way.
Yeah.
So then we might look back at that estate plan and say, we might have an idea of how things should change. We need to review and update that for acquired assets. Hopefully we've grown, we have new assets that we want to make sure are handled correctly. This would be a good time to make sure that spouses are on the same page and that you both have a good plan in place. I don't know if this is the right stage, but we'll talk about it. Is it time your family is aware that, even just aware that you've made a plan, so they can kind of sleep better at night, that they know if you've got a next generation coming behind you, you are trying to plan for that as well. Make sure your wishes are written down. If it's not in writing, it doesn't exist. I say that every time because my boss has drilled that into my head, and I've seen how it affects our customers if it's not. And then also, this is the stage where we might look at managing some of that estate tax liability. So I'll just quickly go over those rules. For years, I've been saying, oh, it's going to sunset at the end of 25. Well, good news, the big beautiful bill allowed it, so it did not sunset and made our new rules permanent as they can be. So our estate tax limits for this year are $13,990,000 per person. So a married couple gets 2 of those. And we still have portability where we can use our spouse's unused exemption. So as long as we have an estate less than that and we haven't used it up through gifting, we wouldn't owe any estate tax on a federal level. 40% over any dollar over that. For 2026 and beyond, after the big beautiful bill passed, is $15 million indexed for inflation. So we stay at that $30 million for a married couple. I am so glad somebody finally made it at even-ish number, right? So I don't have to remember all of those crazy numbers. So we avoided that sunset where it would revert back, which had been a problem for a lot of farmers, just given the fact of the appreciation in the assets that you own. So maybe not that urgency to use it or lose it before that sunset, but I would stress don't put off planning just because you think it's permanent, because we've all seen what that means.
Yeah, permanent is not, it's permanent until it changes, right?
Yeah, exactly. So I'll just touch on this again quickly. Minnesota never changes its rules, and they still aren't that great. For people who live in Minnesota or have real estate in Minnesota, the estate tax limit from a state perspective is $3 million per person. We do not have portability, so if the first spouse doesn't use it, you lose it, and then our second spouse might have that estate tax upon their passing. There is an exemption, an additional exemption of $2 million that we can achieve for qualified small business or farmland, but we need to meet specific rules there. Even if you live in North Dakota, South Dakota, or some other state and own real estate in Minnesota and have an estate over their limits, you could essentially owe Minnesota on estate tax on a prorated basis. So their rates are 13 to 16%, so we need to make sure we're looking at your whole picture there. So in that stage, you might be looking, am I going to come up against that? You might think never, but we might need to start looking at tools, maybe life insurance to fund how are we going to pay if we do have this estate tax liability.
All right, we're still growing, right?
We are growing.
Okay, so we probably have a family, and we know families cost a lot of money to have, so remember what the discussion about how that all works and what your tax return looks like because of those expenses. And remember that when you make a principal payment on land, that's not deductible, and that increases your tax return income. So we also have to, if we're going to be qualified to borrow money, we have to have a balance sheet. So the way you build a balance sheet, part of that is by paying some tax smartly at the lowest possible rates. And that's how we talk about that during tax planning is, what's the best spot for you to be at? Yeah. And so we have a lot of things we can do even after the first of the year, working through deferred payment contracts, your installment contracts that the elevator gives you on January 2nd. That can be moved to either year if you have them in place with the elevator. Avoid sand traps. And one of those sand traps is continually paying off your operating with before tax money, like on January 2nd. That money is all going to add to your income on your next year's tax. So if you build that up over the course of your stage 2 here, I mean, that could be a potential problem. Another sand trap that happens is if we're direct expensing a lot of equipment and or drain tile, and even using special depreciation on a building, and you're making payments on those you've already lost the deduction if you do it all at once. We have to think about this wisely, and where's the best spot for you to land on your tax return. And we have a lot of options we can do to help. We do.
Yeah, it's not easy to get out of those sand traps. So if you get to the next stage and you're like, Bobby, I want to retire, but I'm stuck here in the sand, it's really hard for me to get you out tax efficiently because you've been deferring. And if we did a good job in stage 1 or at stop 1, we would have also told you that just because it's deductible does not mean it's free. I don't know why farmers think, well, it's a deduction. It's not free. You still have to pay for it.
Yeah, that's right. So some of the big, beautiful bill highlights we're going to touch on today is the increased deduction on equipment, drain tile, and multi-purpose buildings, grain bins, increased to 100%. It was scheduled to sunset in 2 years. It was going to be 40% this year. This year it's 100. So that's going to make our tax planning, we can make your tax plan work easier if we have that deduction, and we do. So we celebrate that. The Section 179 is a similar deduction. Some of the larger operations will be limited on some of that, but we can still work with SDA and 179 to get the farmer in the right spot, and that's our goal. 199A deduction, huge. It came with that 2017 bill, and that has been a really nice deduction. It's a 20% of your net farm income, depending on your phase out. Some of that can phase out, but if you're phased out with a $400,000 or so income, you also can use the assets that you purchased in the last 10 years, like your equipment and drain tile and that type of thing, and your wages, and how much of it is being sold, of your grain is being sold to a co-op. All of those things are intertwined in a complex formula to help our farmers. It's been a wonderful thing. And the co-ops also pass down that deduction to you also, whether it be a beet company or your grain elevators. It's been a wonderful deduction to talk about. Okay, only reason I have crop insurance changes is because, we've always been able to defer crop insurance, and depending on your crop and that, but we just want to highlight what they're going to talk about tomorrow. Crop insurance has got some wonderful options that came with this bill, so we want to highlight that. Okay, lower tax rates remain. Okay, so we're still at the 10, 12, 22, 24, 32, up to 37. But they're lower than what they would have been if this big, beautiful bill wouldn't have passed. So we celebrate that. Brackets are getting bigger. They're indexed for inflation. Smaller one for kids parents that have children that are under 17, that went increased from 2,000 to 2,200. There's a phase out there too at 400,000 where that phases out too. Okay? So
it's not nearly enough for the 13, 11-year-old I have.
No.
So in this stage, we're also looking at that strategic plan. So what are we doing to define our legacy? What do we want that to be? We don't have to know all of the answers today, but maybe asking ourselves some of those, what if this happens? Am I ready? What if this happens? What if that quarter across the road comes up? Am I ready? All of those things, defining our legacy. Do we want it to be, we want to own this much land. We want our children to come in. We want, whatever that legacy is, it's different for everyone. But communicate those goals with your advisors so they can help you get there. You have that great team you've built, and see how we can try to do that. Also, write it down. Seems silly, but honestly, if you write it down, now we can go back and say, well, 2 years ago, I wanted this. Am I there? Am I closer to there? Then we can use those long-range goals to make some of those short-term decisions versus being reactive and just making the decision in the moment. So Dane's just going to share a little story. I've had the opportunity to work with Dane, but...
Yeah, so in my role, I've seen a lot of stories, but some of them are similar and some are not. But my story was when AgCountry first started having this people like Bobby S&R in 1993, my mom and dad went to see them. They were 58 years old. And they saw the need with my sister and I to put their will together and make a plan to help the farm continue. Because of that decision, that legacy of our farm continued because my dad made the right choice. He didn't sit on his hand and say, I'm going to wait till I'm older to make that decision. They sat down at 58, put things together. 3 years later, and I'm farming with him all along. I'm in stage 2. And Dad's in stage 3 at 58. But he had a stroke and he died at 61. He died 2 days after he had a massive brainstem stroke. And I just thank the people at AgCountry at the time, and that my parents especially, that they had the foresight to make a decision to have a plan for the farm. And because the farm is still going because of that. So, and that's why I really am passionate about helping farmers with transition, because I've lived it and I appreciate what my ancestors have done for the farm. Currently, my son lives on the farm and I do this full time, right, Bobby? And I get the privilege of working with Bobby.
He sometimes helps on the farm, and
I get hard.
You get paid?
No.
Oh. Stage 3, you get to help and don't get paid. So we'll go to this step. So this is kind of where you are now, right? You've passed the torch. You are ready to transition. Your son took it over. He's doing a great job. But when someone comes in and we're at that stage, the first step is usually identifying those income sources. So where's our income going to come from so we can still live the lifestyle we want to have? Sometimes it's, maybe we got to check that lifestyle, or you can either have this or the farm fails, but whatever that conversation might have to be. So we look at Social Security. When should we start? Land rent. What are we going to charge? Again, those clear expectations. Machinery buyout. How are we going to structure this without triggering a bunch of tax? Because we want to watch those installment sale rules to not trigger all the tax to be due in year one. So maybe we're using leasing, things like that. Have we built retirement and investment accounts we can draw on? And then do we have wages or off-farm income that will be coming into the operation? So then we also need to be tax planning. So if we're going to start shifting, how are we getting out? Are we going to be deferring grain? Are we going to be using pensions? So we need some time to plan ahead for these things. So the more time that you can give us to help you, the more we can try to ease the tax burden. Also, machinery, grain storage, or building leases. We're seeing these become a lot more popular for a couple of reasons. Things are pretty expensive. If you walk around here, there's going to be some big price tags on them. And these are a really good transition tools. So if we can use leases on this type of stuff, where both senior and junior are on the lease and we figure out who's making the payments along the way, but that residual buyout is done by the junior farmer, now we've successfully transitioned it without that tax burden. And so we actually, Farm Credit Leasing, we have a couple of individuals here, Tom and Amy, they're in the back, and they'll be at our booth later. They specialize in this, so they can tell you a lot more than I can, but we have seen it be a really good tool in this stage of the game as well.
You sure have. And when we work with people like that, they're very professional, and they help us help the farmer. Oh, big, beautiful bill of retirement. Okay, Social Security planning. So we think about, you've paid in a lifetime for Social Security, and now you're thinking about getting out. We talk about how much we need to know, when do you start? There is no answer to when you start taking Social Security, but you have to plan for it anyway. Medicare comes at 65 if you choose. You have to, if you retire at 62, you know the rules. You can only take a portion of what you're entitled to unless you wait until your full retirement age. So there's a new deduction this year for those that are 65. You don't have to be on Social Security to get this deduction, but if you're married and your income is $150,000 and you're both 65, you get a $12,000 deduction. There's no tax-free Social Security. Let's put it that way, but that's kind of a compromise they came up with. So, okay, we're in stage 3, so we're going to talk to the older generation about the gifting aspect of things. It's currently $19,000 per person that you can give to help take care of estate, to lower your estate.
So that's the annual gift exemption, is that $19,000 a year. This is indexed for inflation. We don't know what that number is for 2026. But again, if you give over and above that, you need to report it. It comes off of that $13,990,000, and $5 million is the new number. So you can, if we need to achieve some goals through transferring machinery by gifting or whatever, we can do more than $19,000 per person per donor, but we need to report it. So I already went over the limits, not going to touch too much on that in the essence of time. So now we're at the stage of transition or retirement, dependent on if you have a successor, if you don't. And now is a really important time to, again, review that estate plan. We've been working on it all along. It's not a one and done. We need to make sure that if there are buyouts in that, they are feasible. Are they affordable for the farm to continue? Do we have to increase discounts? Do we need to make the farmer buy less? Do we need to set a price? Whatever that is, we need to make sure that the buyout is feasible if one of your goals is for the farm to continue. So if that is the case, we're trying to transfer the farmer ranch as an ongoing business. We might have to make some concessions in that document if we're not here to give those breaks while we're living. Or is it simply no, I just want to transfer my assets to my family and that it is what it is and you don't care if the farm continues or we don't have a successor. That's way easier. It's easier to plan. Then we will talk about, because I think every meeting we talk about, asset protection strategies. How do I make sure that I can protect what I've built? And we look towards, tools to do that, whether that's life estate, irrevocable trust, starting to sell the land on contract for deed. Whatever's right for your situation, we'll dig into that a little bit. And then how do you want your land to transition? Are we going to have it left equally to our kids and let them fight it out? Because we've seen that happen, right?
Yep.
Or should we maybe make some decisions now and split it out parcel by parcel? Do we need to use trusts for various reasons? Or do we use an entity to maybe reduce the size of our estate as well as have some rules governing land ownership? So we want to talk about all those things and incorporate it into your plan and make sure that estate plan aligns with your transition plan.
All right.
Why are all these my slides? It's okay.
It's okay.
It's because this one's my favorite. So we're rounding it out here because communication, I say it every single time I'm up here, is truly the foundation of any relationship, operation, business, venture. And I'm not always great at it. My husband will probably tell you that himself. But is your communication going to be either the compass or the storm? And I chose to switch up the analogy a little bit because I know that a lot of you were impacted by the storms that rolled through here that Daryl just talked about in the last session. And do we want to feel what we felt that day we looked outside and our grain bins were missing? Probably not. But poor communication is that storm that just brews quietly and then hits when nobody's looking, and then all of a sudden we're in disarray and we have no good plan anymore. Or we're going to have good communication that is the compass that leads us all in the same direction because we've clearly communicated those plans and we're all headed down the same path. And if we go off path, we know how to get back because we've communicated appropriately. Make sure people understand your plan, because if no one does, that's just a mystery and we can just guess about it. Back to, if it's not in writing, it doesn't exist. So those are things that just never change. If we don't clearly communicate our expectations, they become reality and then they become part of that storm. Litigation is on the rise between family members, so if we're not talking about it, we might get to talk about it in the courtroom, and it's going to be really uncomfortable, and it's going to be really expensive. So if you can avoid that, try to do that with some proper planning. And then, talk about those family meetings. Each family is different. Who should be there? It's always a conversation, but make sure those families are worth it. Don't make it to start drama, but be intentional. Go in with a purpose and be open-minded.
All right. So we just want to emphasize that every farm it's got its own unique aspects of it, and because of that, we offer the opportunity to help that unique farm situation, guide them, be part of their advisory team, and along the way of your journey on your maps, whether it's stage 1, 2, or 3, myself, I'm working with 3 generations and sometimes, and it's quite an honor to be able to do that. And because if all 3 generations, or maybe 2, are on the same path, that farm legacy is going to continue on in a great way, and it's going to help everybody prosper. And when you work with somebody at AgCountry that understands that will help you. So, and it's just not about numbers. There's a lot of times during my visits out to the farm, or they come in, it's really we really take an interest in your farm and your family, and thank you for allowing us the honor to do that. So we are here to help you succeed. So.
All right. Questions?
Go ahead.
Is stepped up basis locked in now? That is a tax question, so I can let Dane answer.
So this has to do with the death, right? If somebody dies with a piece of land and that gets appraised and appraised, yes, that's still available to the person, or it's still available to the estate to get that step up in basis. So they can sell it the next day and have zero tax.
There were no changes to that within the bill.
Yeah.
So obviously there still can be people trying to change that, but now if you do die, you get a stepped up basis. So your, let's say land would get an increased basis. If you sell it, the difference is very minimal because it should be the price as of your date of death, and then the income tax liability is wiped out there.
So, I mean, I've worked with not only, over the course of my years, I've even had to work with customers that have active farming, and they are sole proprietor, and they have pretty bad diagnosis. Sometimes our plan is to not sell that grain until after death. So if that happens, the family can sell that grain with no tax consequence. Just a thought. So
It's not a great conversation to ask, like, well, do you think it's going to be soon? But there is a tactful way to do it, and it might be part of the plan.
Yeah.
That's the only tax-free stuff you're going to get. So unfortunately, you have to die to get it.
Yeah, it's not, but it's something that we offer the options to talk about.
We do not usually offer that. But anyways,
Yeah.
Any other questions? Okay. Well, we'll stick around a little bit. We're really grateful that you all came. Hopefully you learned something and it was helpful. And let us know if there's anything we can help you with.
Thank you, guys.
AgCountry offers a wide range of internal growth. If you have a goal in mind and you put your mind to it, your successes can be endless.
There are so many jobs within this company that you can rotate into.
I like challenges. AgCountry gives me challenges.
Yeah, AgCountry is a great place to work. There's plenty of flexibility. You're never tied to your desk. There's a team here that is always there for you.
Yeah, grab your role and run with it, and always be aware of the opportunities because they're in front of you.